All right. Now, today we are going to be talking about the coronavirus economy, how to survive and thrive it, kind of how to thrive it as our 2.0 self, our highest self. So, if you have questions about the COVID-19 economy and how you should be investing and saving, then this workshop that you guys all signed up for is for you. Certified financial planner Haley Dixon is going to share tactical and mindset strategies to gain clarity, confidence, and peace of mind amidst all the chaos and uncertainty of the coronavirus pandemic. So in this hour-long session, Haley will share ideas on how to not only survive the COVID-19 economy, but also thrive through it. She will touch on the stock market, how to make sure that you're protected properly, and help us understand how the stimulus package may actually be an opportunity for us. So please help me welcome Haley Dixon. Thank you so much for joining us and leading us through this workshop. Now, if you guys are all ready for Haley to take over, in the chat right now, say, "Show me the money!" Woo! Thank you.
Love the energy. Beautiful. Wonderful. Well, thank you so much, Forward Female. Thank you to Jess and Priscilla and Lo for having me here. It's such an honor to serve communities like this. I'm based in Los Angeles, although I've been in Palm Desert for 2 months with my 4-year-old and 2-year-old and husband and in-laws. And I may never come back. It's so damn beautiful here. So I'm really grateful to be able to just spend some time away where toilet paper is on most shelves readily available. As Jess said, I'm a CFP, a certified financial planner. I spent a decade in the entertainment industry. I was SVP at a studio. And so if anyone is in that industry, I certainly speak that world and cater to that industry in a big way. I work primarily with women, LGBTQ, and people of color. Those are really kind of my impact communities. And, as a woman, I think there's only 6% of people that do what I do are women. And so I'm really excited to talk to you all today because, of the thousands of conversations I've had, I've found one very significant pattern, which is when it comes to financial planning, wealth management, taxation, 401ks, investing, saving, budgeting, yay, good morning. We're never taught this, right? So, no one ever teaches us this typically in school or even in the home usually, right? So that's kind of the first thing. And the second thing is that even though we're never taught, we have this societal pressure, that we feel like we're supposed to understand it. And then that creates shame, and we tend to have a lot of fear around it. And then we have this false notion that everyone else around us understands it. And I'm here to tell you, ladies, most people don't understand this whatsoever. And I'm telling you, I work with highly sophisticated, highly educated, high performers, So I just want to open this up with the intention of creating a really safe place. There are no dumb questions. I'm sure if you're asking a question, most other women on the call also have the questions. So I also want to say, just be patient with yourself. I want to take you through some big concepts. I don't expect you to understand all of them, but I think it's important to give you some texture from a macro perspective. And I would just say, if you can aim to have 3 takeaways, right, no matter how big or small, if you can, hang up this call in 55 minutes and say, I had 3 takeaways, I learned 3 things, and not judge yourself for the other, 25 plus things that you didn't retain, that's a win. Okay, so the agenda today is going to run through what we're going to talk about. I'm going to do a kind of rapid fire questions, or I'm going to throw 3 questions at you. You'll have 1 minute each to answer the questions. Feel free to, type into the chat box if you would like to type into the chat box, and then Jeff will relate some of the questions and we'll answer them towards the end of the call. Then we're going to talk about demystifying and debunking the stock market. It is so unnecessarily complex, and my goal for this call is for you all to hang up and really have an understanding of how the stock market works. Stocks, bonds, mutual funds, ETFs. I promise not to put you to sleep. I actually think it's quite interesting, and I want to paint it from a storytelling perspective. So we're going to talk about what should we be doing in the COVID economy. Should we be buying? Should we be selling? you know, kind of the anatomy of market declines and what we've seen historically and what we can expect in the past. And then finally, kind of 5 takeaways of things that you should be doing now to take advantage. And I don't have shame around this, right? I mean, I have, you know, I think the way that I really work with my clients is I apply strategies that billionaires, millionaires, you know, are doing, take off a few commas, and I apply them to my clients. And there's no reason why, you know, everyone on this call cannot take advantage of some of these strategies. And it doesn't matter if you have $50 a month to spare or $50,000 a month, right? So they're totally accessible. And then I want to talk about just about 5 or 6 minutes around budgeting, especially in the COVID economy, and what we're learning about how much money we spend that we may not need to spend in the last 8 weeks, right? It's really interesting. I think people are going to come out as being a lot better savers. And then finally, I want to end with the CARES Act, the stimulus package. And, you know, I want to talk about, and I'll kind of throw it out there to see what's most relevant to people, because there's a lot of things to talk about, but the things that I was thinking I could focus on is the Payment Protection Act, right? 1 second here. The stimulus deposits, okay? How we could potentially access some of the dollars from our retirement vehicles, unemployment, okay? And then we'll just end with some questions, okay? And I have a fun little giveaway at the end too.
Yeah, so during your presentation, if you do have any questions, please pop them over in the chat. I will keep track of all the questions, and at the end of the presentation, I will ask Haley all of those questions that are in the chat. But Haley, thank you so much, and I'm excited to dive in. If you guys are ready to dive in, say, let's go.
All right, perfect. Okay, and I'm going to be showing you some charts and some historical data and things, and you know, I'm going to be moving relatively quickly because I do only have 25 minutes, 30 minutes. So again, you know, as long as you can follow the gist, you're winning, okay? All right, great. So I'm going to kick off slideshow here and share my screen. Share screen. Okay. Can we see the screen? Yes?
Yep.
Okay, perfect. All right, so these are going to be the rapid fire questions. We're literally going to have 1 minute. I know it's not that much time, but 1 minute for each question, okay? Here's the first question. What is one thing you think you should understand about finances, but you don't, and you're terribly embarrassed to admit it? 1 minute. All right, about 15 seconds here. All right, next question. What is one limiting belief that is holding you back from accumulating wealth? What is your story that you're telling yourself as to why you cannot accumulate wealth? All right, and finally, what is one tactical takeaway you want to be sure to get out of the next 45 minutes? All right, we'll wrap in about 10 seconds. Okay, thank you for participating. I'm looking forward to kind of hearing what your questions are and giving some feedback. So let's dive in. Demystifying the stock market. How many of you feel like this when you're listening to CNBC, or we all have that guy friend that thinks he knows what he's talking about and they typically don't. They just sound confident. So really what I want to talk about here, hold on one second actually. I'm going to pull something up. I want to do, sorry, one second. Okay. Can you still see the screen or no?
Yeah, we just see like the back, like your desktop saver. Oh, there we go. Yeah.
Okay, hold on one second because I got to be able to see my notes too. So hold on. Thank you for your patience. Okay, there we go.
All right, yeah, now we're back to the slideshow.
Perfect. Okay, great. So demystifying the stock market. So I want to talk about a stock versus a bond versus a mutual fund versus an ETF. All right. And again, this is going to be quick because I could talk about this for an hour. So stock, right, is you buy a share in a company. If the company does well, you make money. If the company doesn't do well or goes bankrupt, you lose your money. It's gambling and it's risky. A bond, which is also called fixed income, is an IOU to the government or any kind of corporate organization. So you're lending money to an organization and they're promising to pay you back in 10 years, 15 years, 20 years, whatever the term of the bond is. In exchange for that loan, you're getting a percentage of income, right? That's why it's called fixed income. You get an interest rate. So if a bond is $1,000, you loan $1,000 to somebody and you're getting a 5% fixed income, 5% yield, then you make $50 a year. And then you pay the $1,000 back, the principal, in 10 years, let's say. And so the purpose of bonds is to generate income and they create safety on a balance sheet, right? So if the market's going like this and you have more bonds, you're gonna go more like this because you're not gonna capture as much upside. If the market goes up, you're not gonna capture as much downside, okay? So that's a stock and a bond. A mutual fund is just a fancy way of saying that you buy into thousands of different stocks and bonds with one kind of share. And so you have mutual fund managers and his or her team of analysts. And so it's a user-friendly way of instantly diversifying. So you could decide what 1,500 stocks you want to buy. That's a lot of analysis and pretty challenging to do. Or you could buy one share of a mutual fund and then instantly you're diversified across 1,500 different companies, for example. There's thousands of different mutual funds, okay? A mutual fund is actively managed. You have that team of analysts that are telling you, right, what they think you should buy. An ETF is also a basket of shares or a basket of stocks, a basket of bonds, but they are not actively managed. And so they're a lot cheaper and they're very like hot topic now. People love talking about ETFs because the expense ratios are lower. I recommend my clients do both, some mutual funds, some stocks, okay? So I want to share here a document I'm going to pull up that looks at risk of loss in the stock market, okay? And I think that this, hold on, this is like all you really need to understand about the market. Can everyone see it okay?
Yep.
Okay, so this shows real data answers the question of, historically, what is the chance that I'm going to lose money if I invest in the stock market? Okay, between 1926 and 2019, a lot of very bad things happened, right? Great Depression, World Wars, .com, 2008, the Great Recession. So let's start down here where it says 100% of the time positive. What this is saying is that if you invested $100 in the stock market anytime between 1926 and 2019, 100% of the time, if you had a 15-year timeline, right, 100% of the time you were up on your money. So I can't guarantee that, you know, what happened in the past is going to happen in the future, but I can tell you that I feel strongly if you have a 15-year timeline, we should be really aggressive with your money because it doesn't matter what happens tomorrow or in 5 years, etc. So as many of you in your 30s and 40s and you have retirement vehicles, IRAs, SEP IRAs, 401ks, we want to make sure you're super aggressive, right? Because you have greater long-term potential returns if you're more aggressive now, as long as you can ignore volatility, which we'll talk about, okay? And then we say, well, what happens if we have a 5-year timeline? So, you know, if the runway shrinks from 15 years to 5 years, well, 87% of the time, you lost some of your $100, right? If you fast forward 5 years, anytime between this time period. So we probably won't take as much risk if we only have a 5-year timeline. When my daughter Isla, right, is 14 years old, if she wants to go to school, 13 years old, I'm probably not gonna be as risky because I need tuition in 5 years. That's a requirement, right? And then we say 1 year. What's the chance of losing your money in any 1 year between this timeline? And the chance is about 27%. So another way of thinking about this is 1 out of every 4 years, the market returns negative. That's just how it works. So the way that I think is, if you need anything, like if you need money, if you need the liquidity in the next year, even 2 years, it shouldn't be in the market, right? So when I build portfolios for clients, what I think about is what is the purpose of this money? What are we trying to achieve with it? And a lot of times people don't know, so I help them figure that out. What are we trying to achieve? How long until we want that thing, right? And then we back into how much risk we're going to take and what is your risk tolerance. And we don't change that unless something in your life changes, right? I was just say any questions, but I won't say any questions. All right, so let's move on to something else here. This is interesting too. This is the importance of staying invested, and this is so critical right now. All right, so this shows you January of 2007, right, through January of 2018. So you can see here what we're really going to be focusing in here is the 2008-2009 crisis, okay? And so what this shows you here, this blue line, is an investor that stayed invested, that kept their cool. Warren Buffett, I love this quote. He says, "The market is the most efficient way to transfer money from the impatient to the patient." And this is such a great illustration of that. So check this out. This person stayed invested, right? They both started with $100,000 in January of 2007, right? By January of 2018, this person had $238,000. They just rode this wave, as brutal as it was, and as much as they are freaking out on this downturn here, they stayed with it. All right. This person here exited the market at the bottom, stayed out for a year, and then got back in. And this is the difference. And sure, maybe if you exit the market here, you get lucky and you get back in here, but that doesn't typically happen, because timing the market, you have to be right twice, when to get out and when to come back in. And it's very challenging. I want to share this too. This shows the cycle of an investor's emotions, right? So think about this as the market goes like this and how we feel. So here's optimism. I just got in the market. I'm a new investor. This is amazing. Oh my God, I'm making money. It's going up. Oh my God, this is, oh shit, right? So you have that feeling of right around here, denial, fear. This is what I have been the last 6 to 8 weeks. I've had, 5 to 6 dozen calls with clients, coaching them through here, coaching them. That is the most value that I can add, is showing clients that, we all understand, right, that we should buy low, sell high. We get that. But it's harder to do that in the moment. When things are going down, people want to pull out, when actually we should be putting more in, right? So just remember that this is the critical part, because we will get through it. Interesting, right? Okay, so let me get back to my presentation here. Okay, so let's talk about diversification quickly. So
we still see the cycle of investor emotions.
Yeah.
Okay.
All good. So before I go to the next slide, because it's got a lot of we got a lot of images on it, I want to explain. So diversification, right? Another big concept in investing. We all, I think, understand diversification, right? You don't want all eggs in one basket. And it's probably the most common word associated with investing. And I want us to think about diversification as all it means is that you own some of everything. There are 9 asset classes that we can invest in. Every company in the world fits inside 9 different asset classes. Okay, I'm going to pull up a chart and show them to you in a moment. But I want you to understand that diversification just means that we own some of everything. So we can be super aggressive and diversified. We can be super conservative and diversified. Now, if we're more aggressive and diversified, we'll have a teeny tiny amount of bonds, maybe none at all. If we're quite conservative and diversified, we'll have a lot of bonds, right? So a 95-year-old woman is going to have a lot of bonds because her biggest goal is to preserve her principal and generate income. A 35-year-old woman, if we're talking about retirement, is going to should have very minimal bonds because our goal is capital appreciation and growth. We don't need income, we're working, right? So let me show this. This is not a periodic table, although it looks like one. So you're gonna say, what does this mean? What is she putting up here? So basically, this is, and you'll get this. These are all the different asset classes you can invest in. Okay, large cap, mid cap, small cap. That's a fancy way of saying large companies, middle-sized companies, and small companies. All U.S. companies. Okay. Then we have international companies. We have bonds. We have commodities. Doesn't really matter. That's another talk, another time. But what I want to show you is why diversification is so important. Is that there are no patterns. This is the best performing asset classes between 2005 and 2019. Remember, there's 9. And the worst performing down here. And they're all over the place. And it's really easy for, Mr. White Guy with the gray hair on CNBC to look back and sound really smart about why he did what he did. He's probably not talking about what he did that didn't work out for him, right? But looking forward, it's very challenging. And so what I want you to look at, let's look at international emerging. International emerging are like parts of Asia, China, Russia, Brazil, right? Countries with a little bit more geopolitical risk. So 2005, best performing. Second best, best, worst, best, worst, best, second worst, all over the place. The one pattern that you should see is the white, and that is a diversified portfolio. And I can get into another time kind of why that is. There's a Nobel Prize that was awarded because of what's called the modern portfolio theory. But essentially it means that if you own some of everything, you're reducing your risk across the board, no matter how aggressive or conservative you are. A lot of the times I get into my clients' portfolios and they are 100% in large cap. Amazon, Netflix, Apple, IBM, GM. Why? Because that's what they know. That's what they know, and so I think it's really important that, especially nowadays, that we have a lot of international exposure as well. All right.
So what does it mean to have like a diversified portfolio? Like what would be some examples?
A diversified portfolio would see all these asset classes. You have some of all of them.
Oh, okay.
Mm-hmm. Great question. So, and then it just depends on how aggressive you want to be. So if you're super aggressive, you'll still have some bonds, but a very tiny amount. So you just have some of all of these asset classes. Great question. Okay, cool. So I just want to give some COVID kind of facts, which I think is really interesting. And then I'll kind of end this section with kind of 5 things that I think that, that I would recommend that you really think about and do over the next few weeks, months. So the S&P, right? The S&P 500 is kind of the barometer of the stock market, right? It's the 500 biggest large cap companies, the biggest companies in the US and really in the world, right? So the S&P 500 hit its all-time high February 20th of this year. That seems like eons ago, but that was not very long ago. It's all-time high in the history of the index, okay? So 22 days later, it had gone from its all-time high, it dropped by 34%, okay? That is the fastest it has ever happened by far, meaning that fast of a drop. That's why it was such a shock to our system. It was really scary and the uncertainty, In 2008, just to give you an example, it took 256 days to drop that much, 256. So 22 days was really fast. And then you look at this morning where it opened, and guess what? We're already back up 20%. Okay, so now we're down 14% from that high. We're still down, but you know, clients that had pulled their money out, or anyone that pulled their money out when they, you know, when it was down, well, it's important to understand the difference between a realized loss and a recognized loss. So let me just throw this knowledge at you really quickly. A realized loss means, all right, it's gone down 34%, but I haven't sold anything. I still own the position. So you've realized that loss, but you don't recognize the loss until you get out of the position, until you sell, right? So if someone did freak out and sell, then they're taking the loss. They're saying, you know what, I'm going to take this loss. And they lost 34% of their portfolio, right? So those that are patient, we come back up. And going back to my initial point, if you need the money now, it shouldn't even be in the market, right? So I want to make sure that my clients have luxury of time. They can make non-emotional, logical decisions around their investing. Okay. All right, so 5 kind of quick things to really think about. The first thing is buy the dip. So meaning, if you have the resources, and again, $50 a month, it doesn't matter the amount, right? If you have the resources, start to put some money into the market slowly, right? Maybe $50 a month, you know, $5,000 a month, whatever your number is, over the next 3, 4, 5, 6 months. So meaning agree, so let's say that you have, you know, $300 that you want to put into the market. Give yourself a 6-month timeline and commit today to putting $50 in the market once a month for the next 6 months. And don't change your strategy depending on fear, speculation. Just commit and then do it, right? And make sure that you don't need that money for the next 18 to 24 months, that you don't feel forced, you know, to liquidate it. So buy the dip. The second thing is to rebalance your portfolio. Basically what that means is to work with your advisor or work with somebody to ensure that as the stock market, the equities, the stock side of the market is depressed, your equity valuation on your portfolio is lower. And so you may want to sell some bonds and buy some stock, okay? That might be complete French, but happy to discuss it further if it's of interest. All right, the third thing to think about is tax loss harvesting. Again, kind of an advanced concept, but what it means is, let's say that you invested in some cannabis stock a few years ago, and you also bought Netflix, and you've lost money on the cannabis stock, and you've gained a lot of money on Netflix. You could decide to sell both at the same time, and then offset the taxes you'd have to pay, because you have to pay capital gains taxes on the gain you made on Netflix, okay? But if you had a loss, you can sell both in the same calendar year, and then if you had a loss here, you could write it off against your gain, and then you don't have to pay taxes on the gain. So if you have some losers out there, might be a good time to get rid of them if you've got gains elsewhere and can offset. The fourth thing is apply for long-term disability insurance. This is so important. It's income protection. There has never been a time in my career, certainly, where ensuring that you have income if you're unable to work is more important. Okay, so disability insurance, if you work for a W-2 type, you know, company, you'll have some sort of group policy. You want to make sure to supplement whatever you have. A lot of my clients are freelance, right? Self-employed, 1099. And so if that's the case, you know, I will go out and build, you know, plans for them because they don't have all the group benefits that W-2 employees have, but they have a lot of tax benefits. So buy and apply for a long-term disability. And then the fifth thing is stay close to an advisor, your advisor. And the other thing I want to share is it is never too early to have an advisor. Right? I think a lot of people say to me, well, I don't have wealth to manage, you know, and I say, well, would you like to have wealth? Is wealth a goal? And if it's not, that's fine. But if it is, then finding someone you can partner with for 30, 35 years to help you figure out, how do I snowball this debt? Should I refinance my student loans? How do I pay off this credit card? What makes sense? How do I get my credit up? There's a lot of defensive planning that goes on before you can focus on growth, right? Accountability around spending, okay? All right, I'm gonna pause there. Jess, everything good on your end?
Yeah, everything's great. We have quite a few questions in here. So I don't know, do you want to start answering some of these? Or
well, how long? I have like 10 minutes left, right?
well, we can, yeah, 10 minutes before we get into dive into the Q&A.
Okay, let me do that because I have 5 minutes budgeted for each next subject.
Perfect.
And then we can answer them all, because I'm afraid if we answer questions now, then I won't even get to the next two. If that's
I love it. Keep going. This is awesome.
okay. Perfect. So let me get this back. Okay, so this is going to be, I hope I get a laugh for this. Here we go. I did this early this morning. So a COVID-19 budget is not a cage, right?
Yeah.
Okay. So I want to just talk about budgeting. And it's, you know, I think it's impossible for any human being with a heartbeat to budget, to have a monthly budget. And you might be like, what? You're a financial advisor. What I mean by that is, today is, what does it say, the 28th of April. If you go to the store and you're like, oh shoot, darn, I've spent my April budget for groceries, I can't buy food. I mean, it's not how we live. Every month is different, it's not linear, right? And so the way that I work with my clients in terms of budgeting is I want them to fill out a budget. I want them to create awareness around what they spend and why, creating that accountability. But really what a budget to me, means is, let's figure out, what are we bringing in monthly, quarterly, annually, however your cash flow works. What does it cost for you to live a joyful life? It's very important, a joyful life. And what's the difference? And we hope there is a difference. If there isn't, we work to get to that. But basically, we take that surplus and then we put it to use. We deploy it on your behalf across different strategies, short-term, mid-term, and long-term strategies, both growth and paying off debt. And so by default, as long as you're taking a certain percentage of what you're bringing in and putting it towards your goals, whatever's left over is your budget. And I think that that's just a much easier way to I think, grasp your mind around how you budget. So a lot of people have this limiting belief of, well, I just can't stick to a budget, so that way I can't save. I'm like, wrong. Let me show you the actual answer, to that. And the other thing is, I think we feel so, one of the reasons why we don't plan as well is we're so worried about, committing to anything. And, well, I don't know when my next gig is, or, I don't know when my next job, or, whatever it is. And newsflash, none of us know what's going to happen in the next minute. Like, doesn't matter if it's COVID or not COVID. We don't know. And so not knowing what the future holds is not a reason not to plan. You can only plan for what exists now, today. And then as life shifts and evolves, then the plan must do so as well. And so if that's your limiting belief, then we got to crash through that as well, okay? All right, so I just want to talk with us about COVID is, I would recommend, I've been doing this with my clients, I call it the Thriving Through COVID call, where, we had their pre-COVID budget, right? So all the money they were spending eating out and on personal care and nails and travel and all these things, they have their pre-COVID budget. And then I have clients that have called me, freelance DJs, for example, that, have no gigs. What do we do? Or clients that are W-2 employees, agents, at CAA that have had their, salaries cut 35, 40%. So we've been doing a pre-COVID and then a post-COVID budget. It's been enlightening. I really would love for you to think about, what did I spend before? And I can share a template too, Jess, if you want to share. I have a great budget template. I have an Excel, and I also have a colorful PDF because people tend to like one or the other. But what did you spend before? And then do one now. And it's just going to be an amazing exercise and awareness around spending. So if you're one of the people that said in your mind, when I was saying earlier, like, what do you bring in and what does it cost? If you're like, I'm paycheck to paycheck, like, I don't have any extra. This is for you, because we can always find something extra, and you can always kind of figure out, where can I save a little bit more? So I think that's really interesting. It's like, this is a lesson in saving. It's, where we've been spending money that actually is not where we derive the most joy, right?
Mm-hmm.
So I think it's really a wake-up call on how much we spend. All right, moving on. So how the CARES Act can help you. CARES Act, Coronavirus Aid, Relief, and Economic Security Act. Kind of catchy, right? Go Congress. All right. So does anybody here, and Jess, maybe you can look at the chat room for me. Does anybody here have employees? Like, have they applied for the PPP, the Paycheck Protection Program? Is that something I should talk about? Yes or no? Or is it irrelevant?
If anyone wants her to talk about it, just raise your hand or put it in the chat.
The PPP?
Yeah, I think most of the people don't have employees. They're
Okay.
mainly solopreneurs.
Okay, sounds good. So then, and forgive me if you know some of this stuff, but the stimulus deposits, right? So I think there were a couple of questions about that Jess had sent me. So, and again, I also have like a bullet point summary of this that I think is really great, and I can send through as well. But the stimulus deposits, you don't have to do anything. If you filed your taxes for 2018, they will work off of that return. If you haven't filed your taxes for 19, if you have for 19, they'll work off of that return. If you haven't done 19, they'll look at 18. So if you paid your taxes or received a refund in 18 or 19 electronically, then the $1,200 or the $2,400 should already be in your account or should be incoming. Okay, if you didn't do it electronically, they're gonna have to cut a check, and that's gonna take longer because they got rid of all their check cutting facilities, and so that's kind of a backlog. So this is what it is. If you're a single tax filer and you made less than $75,000 per year in 19 or 18, you'll get $1,200, right? And then you get an additional $500 for every dependent. Okay. If you are married filing jointly and you made under $150,000, then you get $2,400 plus $500 for every dependent. Okay. All right. So no action needs to be taken. It should just show up in your bank account, or you'll get a check in the mail supposedly at some point. All right, one thing I want to also bring up about the CARES Act, and again, like, this is not something I recommend, but as a last ditch effort, if anyone is really freaking out about liquidity, like how am I going to actually pay my bills and eat and all these things, if you do have retirement vehicles, IRAs, Roth IRAs, 401ks, this is, again, last ditch, but it is available. If you are impacted by coronavirus, either you have the virus or someone else has the virus, you're taking care of them, or you're furloughed, you can't get employment because of the virus, then they're allowing you to take money out of your IRA, Roth IRA, traditional IRA, SEP IRA, 401k, penalty-free. So typically you get a 10% penalty, right, for taking early withdrawals before you're 59 and a half. So penalty is waived. And you will also not, this is big, not have to pay taxes on the withdrawal as long as you put it back in within 3 years. Okay, so that's huge. So, I had a client that, I sent him $20,000 from his IRA yesterday. I wasn't thrilled about it, but we have a very clear plan that he's going to get it back in the next 6 months, right? It was a short-term liquidity need, and it was a great way for him to have cash flow. But I'm his accountability partner. I can be very bossy. So he's afraid of me if he doesn't, right? You really want to get it back in. Okay. All right. Third thing here is unemployment, right? So I know that the systems have been bogged up, right? I think it's getting better and better from what I can hear, but I'm sure that we also know that if you do apply for unemployment, you can apply as a self-employed individual. Amazing. That's of course an anomaly to the traditional regulation. And then you get an additional $600 per week for up to 39 weeks in California. That's huge, huge. So if you haven't, just keep at it, just keep at it if you haven't been able to get a response or get your application submitted, okay? Don't give up. And then the last thing, and then I'll open up for questions, is, of course, we all know, or at least we should, right, that the tax deadline has been extended, the federal deadline until July 15th and the California state until June 15th. And that means that you also have an extension of the deadline to which you can contribute to your retirement vehicles for the 2019 tax year, right? So if you haven't contributed to a Roth or a SEP or an IRA you can contribute to that vehicle. And if it's a traditional IRA or a SEP, receive that tax deduction for the 2019 year through July 15th. You can opt for a 401k. That had to be done, at the end of 2019, but you can do that. So take advantage of that. All right. I'm going to stop talking because I've been talking for a while.
Wow, that was amazing. A lot of great information. And so I'm going to just kind of work my way up through the questions. The $1,200 is a single payment, correct?
Correct.
And I kept getting a not available when clicking on my stimulus. And then I saw there was a flaw in IRL system, and you have to put your address in all caps, and it allows you to put your banking info.
I'm not an expert on the systems that the government is deploying to deal with the demand for the stimulus, unfortunately. I don't know how to answer that or what the question is actually.
Okay. And then can you please clarify the additional $600 a week for unemployment?
Yeah, so traditionally, right, when you apply for unemployment, it's through the state, right? And every state has its own amount of unemployment. And so what the stimulus package is doing is you're still gonna, apply through the state, and it'll be whatever the benefit that you would have gotten before COVID. And then the government, right, is putting a cherry on top, right, of $600 in addition to what you would already be getting through the California state when you apply for unemployment. So it's an additional bonus that they will pay for up to 39 weeks. It's huge.
So if you're a solopreneur and let's just say your business right now, whatever it is, you can't function the way you did, how do you file for that unemployment?
You go via the state.
Okay.
Mm-hmm.
And then does that still apply if you had to pay in 2018 for taxes?
Does what still apply?
I'm guessing the stimulus.
Yeah, absolutely. As long as you filed your taxes in 2018, whether you paid or received a refund, if you made less than $75,000 as a single tax filer, you receive $1,200 plus $500 for every dependent. If you're married filing jointly and you made less than $150,000, $2,400 plus $500 for each dependent. Doesn't matter if you receive a refund or had to pay taxes, correct?
Okay. And then people are saying they definitely want your template. They need you in their life.
I love that.
Do you have to pay off all your credit card debt before you start investing?
Okay, I love this question. Thank you to whoever asked this question. So the answer you're not going to love is it depends. But my general philosophy is no. Because and it totally depends on the person and kind of how much debt you have, the interest rates. I mean, let me give you an example. If you have $6,000 of credit card debt and we've determined that you can pay it off in 18 months, what I would most likely recommend that we do is transfer the balance to a zero balance card. That we have zero interest card. We have zero interest for 18 months, and then we have a payment plan, and we just pay it off for 18 months, right? And we're not getting penalized for that. Meanwhile, we're able to take some of the money, right, that we would have been overpaying with the interest and, trying to snowball the debt, as Dave Ramsey says, and we can actually put it into the market. The only reason why you should overpay, something is if you think that the opportunity cost isn't greater elsewhere. And so in that example, I would say no. If we have a clear plan of I can get this paid off in 18 months, then we should put money elsewhere. If you're, $60,000 in debt and, have very little spread to pay off the credit card, then most likely we need to make a major life shift, and you shouldn't be investing until we make that shift, i.e. reducing rent, selling your car, right? So that's a bigger kind of shift. But most of the time, debt is a big item for me. But I think that in isolation, it can be detrimental, because a lot of times people say, I'll start investing after I pay off my credit card debt. And then 2 years goes by, 3 years goes by, and you still got this debt and you've missed out on time. Because, Einstein said, I love this. He said, the eighth wonder of the world is compound interest. right? And so what you can't get back is time. And it's so critical to begin putting something, flexing the muscles in the market. Don't care how many zeros, right? Don't care. That was a great question. Thank you.
Thank you. I think Rachel asked that question, so thank you. Also, let's see. If you do mutual funds, how do you do it ethically? Meaning none of your money goes to arms and profit jails and companies owned by Sacklers.
Yes, yes, great question. And of course, this comes up a lot being that, you know, we're in California. So about 5 years ago, it was very challenging to build a portfolio that's socially conscious. And now it's become it's really not hard at all. Morningstar, which is the analyst that most broker dealers use to, you know, look at the ratings of a mutual fund, now has, which is so exciting, it came out last year, like each fund has a socially conscious rating, like, you know, out of 5. And so when I'm building a portfolio, like I'll go through, I just do this anyways, you know, depending on the client, if they're, you know, no oil, no this, no, you know, then I can go through and build a socially conscious fund. It's also called ESG investing. So you can Google like ESG investing. That would be socially conscious investing. So it's become a lot easier. It's not as easy as building a, I don't know, non-socially conscious portfolio. And you have to understand that the data that we have so far on the performance of those is limited, but so far it is showing that the returns are not as great, you know, so you just have to figure out like, what are you willing to give up?
Okay. And then if you want to start investing, let's say $50 a month, what is the safest way to do that? Just because we're just learning, we want to, you know, try it out and really learn as we're investing a little bit each month.
Okay, so great question. I would ask, again, let's go back to, if we want to invest $50 a month, the first question I want to know is what is it for? Whoever asked that question, what is it for? Is it for retirement? Is it for a house fund? Like, what is it for?
Probably just to learn how to invest.
Okay, and is this money that you think you may want to have access to or need to have access to in the next 24 months?
No.
Okay, so again, that's how we build a portfolio, because when you say low risk, well, that to me as a financial advisor, as an investment advisor, means bonds. That means that, you know, we just want to preserve the principal. We don't really want growth, because you have to take risk to get growth, but then you have risk. Right, so every time you think about an investment, you have to think about, you know, what is the amount of risk I'm willing to take? Because the more risk you take, the more potential reward, the more potential downside. And so when you say, you know, conservative or minimal risk, that also means minimal potential for growth. And if that's what you want, then we would figure that out. But if you're okay to take on some risk because you have, you're only doing $50 a month and you don't need that money for, you know, 24 months, then I would probably get you into a just diversified portfolio across a bunch of different companies. And we probably wouldn't be super aggressive, but we would take some risk because we're hoping to get some lift.
Yeah, and they said this is mainly for house fund and additional income.
Okay, so then when people say house fund, because of course we live in California, right? Which is like, if you want to move to Kansas, probably buy a house, right? But we have to adjust our expectations here. Nothing wrong with Kansas. I'm Texan, so, you know, I love the anyways, so when most people, when I start talking with them, their biggest goal is to buy a house, right? And then 2-3 years later, oh, I still want to buy a house. Oh, I still want to. And so if you want to buy a house, that's fine. First of all, I want to talk about why you want to buy a house. We kind of nail into that. Is it because that's what you think society wants you to do? That's what success means? Like, why do you want a house? Making sure that it's the right time. If it is the right time, then we figure out, okay, what's the purchase price of a home that you'd be happy in, right? $750, $500, $1 million. Okay, are you going to be happy in that neighborhood, schools, if you have kids, whatever. So we put texture around the goal. Okay, you want a $750,000 house. Great. Are you going to be, you know, getting help for the down payment, or are you going to be putting it all yourself? Okay, you're doing it all yourself. 10%, 20%. We back into what we're trying to achieve, right? Texture around the goal. How much can we save annually? let's say we can save 500 a month. That's a lot, 6,000 a year. Well, if we need to save 10%, let's say of 750, that's $75,000. We can save 6,000 per year. Well, then it's probably going to take us 10 plus years, right, to get to that down payment in theory.
Mm-hmm.
So that means we now have, the purpose is the house, 10 years, and then we can actually take on quite a bit of, an aggressive posture because we have a timeline. That makes sense?
Okay. Now that you've been talking about all this, people are like, how much does it cost to hire you?
Oh.
Is there a base package? And everyone keeps seconding that question. So
Oh, thanks. Well, maybe it's a good time. This is what I was trying to show you earlier. Look, I did this.
Okay, before we dive into that, one last question, and then we'll get into how we can have you in our lives. What do you think about investing in apps like Robinhood?
Yeah, so, okay. It doesn't really matter the app. Robinhood, Merrill Lynch, JP Morgan, Betterment, like they're all the same. Because just like, they all have access to the same stuff, right? And so it's kind of like with an advisor, it's interesting because I was, in entertainment prior, and coming over here and being a financial advisor, it's like I'm gum on a shoe. You know what I'm saying? I mean, there's so many financial advisors. I happen to be of high integrity and incredible, and I believe that people that work with me, like, it's a gift to them because I work so hard for them. But there's a lot of scumbags. So same idea of like how you choose an app is just how do you like the interface? Like, do you enjoy, the user experience? Same thing with an advisor. We all have access to the same stuff. It's just who do you like? Who do you trust? Who do you feel connected with? And so Robinhood is fine. I mean, it's a great kind of 101 entry level thing. I think if you're just going to play around with, a couple $1,000, a couple $100 here and there, like it doesn't make sense to work with somebody like me. I don't have any minimums, but if and actually go quite low because my whole world is around women, LGBTQ, and people of color, and my whole vision is around shrinking the wealth gap. And in order to shrink the wealth gap, I have to work with people across all demographics in all shapes and sizes, and that's important to me. But that's a long-winded answer to it doesn't matter, whatever you like. Right? It's not like there's anything special other than the platform, the medium to which you're accessing the market.
All right. Well, I think let's end it off on how we can get you in our lives.
Yeah. Okay. So, well, thank you. I hope I know I talked really fast, but I wanted to get in. I hope it wasn't overwhelming. But I was proud of myself. I came up with this morning. I thought you all would like this. The FFF, first 5 fabulous Ford females to follow me on Instagram. Here's my Instagram. The DM, like referencing today's workshop. I'll give a complimentary like one-on-one session. I don't know. I don't think that there's that many people on here. Like, perhaps I could do one for everybody depending on the interest. But the way that I make money, the way that I'm compensated is really 3 ways. So the first way is if there's any money for me to manage. So any assets under management. So if you have an old 401k or an IRA, and we move it over to my management, because again, the money is just sitting at Merrill Lynch or Fidelity or Vanguard. It's like, it doesn't matter where it lives, right? It's, you can invest in whatever. So the way that I make money is if there's assets that I manage, it's a percentage of assets under management. The more money, the lower the percentage. And then I'm also, and I talk a lot about this today, but I also am an insurance broker. So I do things like life insurance and disability insurance and long-term care insurance. Only insurance has to do with the physical body. And so if that is relevant to anybody, then I'm compensated by whatever carrier, I go with, whatever is relevant to you. And the third way is just like, I'm so word of mouth, and, as and if we get to know each other, I think you'll see such a difference in the way that I work with my clients. It's a collaboration, it's a partnership. And so the best way to compensate is just introducing me to other amazing women, LGBTQ, people of color, so that I can add value. And just, I think people just are they run from this conversation, and it doesn't have to be that way. It really isn't. Like it's tragic.
Yeah, I think knowledge is wealth, and just having more confidence with money means a lot. So, I mean, like just you or anyone else, like what is there, like what is like the base cost of working with a financial advisor?
Well, so there is no, like I said, there's no cost. Like you don't, there's no annual fee or hourly fee or anything like that. It's just a percentage of assets under management. So, or if there's any insurance, then I kind of get a finder's fee from the insurance company. And so ultimately the way that I make money is on placing insurance for my clients, and that's no cost to the client, right? So I get a finder's fee, because I'm a broker. And then when I manage people's money, I get a percentage of their total account value on a quarterly basis. So there's no hourly fee, annual fee. That being said, I'm super picky because I can only bring on so many clients and serve them in the way they deserve to be served.
Right.
So, so yeah, it's kind of like this first call, if you all want to have this complimentary session, I mean, I think I can give you, if we're not a good fit, I can at least give you a ton of ideas that you can implement on your own with or without me, or I can introduce you to a more like junior advisor who's awesome, right? But may not be. Basically, it's interesting because I want to make sure that I can serve you properly, and that we're a good fit. So I had this initial call to figure that out.
Well, Haley, thank you so much. I followed you. I know people are starting to follow you right now.
Oh, wonderful. I look forward to those messages.
Yes, and if you want to stop sharing your screen, or here, I think I can actually do it. Let's see. Here we go.
Okay.
But everyone just say thank you in the chat. Haley, thank you so much.
Thank you.
Amazing nuggets of knowledge in there. And like I said earlier, I just think having that knowledge around your finances just makes you more confident, especially as women. Our money mindset can kind of be a little iffy. So thank you so much. And everyone is like, we want you to come back and talk more about bonds and this and that. So we might have you back on again. But thank you so much for offering us a 30-minute complimentary call. We will follow up with all of your information, but thank you so much.